the way. I know German colleagues are feeling a little bit excited, but if you could take your seats. First of all, could I take the adoption of the agenda? Do I take that as adopted? Okay, that's fine. And approval of the minutes of the 5th of September. May I take those as approved? As usual, you've all had them. Thank you very much. Now we've got some Chair's announcements which we can get out of the way before the monetary dialogue. First of all, there's the AFCO report on multi-tier governance, and I'd like to report on the long-standing issue regarding that report. I've expressed several times ECON's concerns on the scope of the AFCO report insofar as it could cover issues on EMU and in particular on banking union, which the ECON committee is currently discussing, has recently discussing, or is in the process of negotiating. For example, SSM, SRM, BRRD and DGS, to give you a few sets of initials. On the 4th of September, Chair Cassini confirmed to me the AFCO committee's preparedness to treat the suggestions in the opinion adopted by ECON as if the application of Rule 50 were granted for Part D of the draft resolution from AFCO. Part D covers the matters of ECON exclusive competence, and ECON will deliver its opinion for its inclusion in the AFCO final report without a vote. So that means we vote, but then the AFCO committee have to accept what we have voted. Accordingly, as well, the AFCO recitals and amendments outside Part D, which are inconsistent or incompatible with the ECON opinion that covers Part D, should not be put to the vote. Following informal further contacts between the AFCO and ECON rapporteurs, ECON is now planning to vote on the 17th of October, which I understand is a date that also meets and is agreeable with the AFCO committee. So it looks like that we have a satisfactory outcome there. Forthcoming simplified procedures, that's Article 46 of the Rules of Procedures. ECON coordinators decided on the 10th of September that the simplified procedure without amendment should be applied to the following files: the EU-France agreement concerning the application of the collectivity of St Bartholomew of Union legislation on the taxation of savings and administrative cooperation in the field of taxation. The rapporteur is Mr Nitras from the EPP. And the second one, amending directives 2006-112 EC and 2008-118 EC as regards the French outermost regions, and in particular of Mayotte. The rapporteur for that is Mr Kaza. And a brief exchange of views and vote is scheduled for the 21st of October. We are also expected to vote on a second quick fix on Omnibus 2 directive, that's concerning the Solvency II matters, on the same date for its adoption in plenary in November. That all, of course, depends upon the Commission delivering in time, which we expect on the 2nd of October. Rule 51, the joint Econ-Libe issue on anti-money laundering directive and funds transfer regulation. As announced last week, the Anti-Money Laundering Directive and Funds Transfer Regulation will be dealt with under Rule 51. That means a joint committee sitting together of ECON and Libe, and in agreement with the 4 co-rapporteurs, because there's 2 for each committee and there are two issues. The tentative calendar has been set as follows: presentation of the draft report Wednesday 6th of November. Amendments deadline will be Friday the 15th of November. Presentation of amendments Thursday the 5th of December, aiming to vote on the Monday or Tuesday 20th or 21st of January. And finally, update on trialogues. A third trialogue on the bank Recovery and Resolution Directive was held on the 18th of September. Revised texts on scope, resolution authorities and special management were discussed. The meeting held further exchanges on the issue of the home host and EBA powers and on conditions for resolution, that is triggers. The next trialogue is on the 26th of September, and there's further offline work on non-papers and exchanges of ideas and texts going on in between. So with that, we can now have a suspension for a few minutes, and I'll go and meet Mario and bring him into committee. Thank you.
Welche denn? Sag mal was. Ist breit.
Okay, we will start if the photographers can at least keep out of the view of members. That would be appreciated. I've had a private little exchange with Mario, and for those of you who follow Twitter, I can tell you he did ask for an FT on the plane this morning, contrary to the allegation that he only asked for a sports newspaper, and they had neither. So I'm not sure which airline it was, but they didn't have an FT. But I'm sure you read it the night before, like the rest of us. Anyway, Mario, nice to welcome you to committee. And you'll present the ECB's perspective on economic and monetary developments, and then we'll go to the usual questions and answers with members. It's 5-minute slots, remember, members, so the less time you use, the more chance you have of coming back for a follow-up question, which are often the ones that will be harder for Mario to answer. So thank you for that, and the floor is yours.
Thank you, Madam Chair, honourable members of the Committee on Economic and Monetary Affairs. It's a pleasure for me to be back with your committee shortly after the important vote of your Assembly on the SSM regulation. This vote has been preceded by intense interaction on the interinstitutional agreement on accountability and transparency. And I would like to thank President Schulz, your committee, and the negotiating team for the commitment to a successful establishment of the SSM. Our two institutions share a common interest in a swift and effective implementation of the banking union. The draft interinstitutional agreement ensures high standards of transparency and accountability, while safeguarding the protection of confidential information. We will continue working with a similar constructive spirit in the months ahead and hope that this will allow a swift set-up of the Supervisory Board. Today, I will first review recent economic and monetary developments in the euro area. I will then address the two topics that you have selected for our discussion: the impact of our non-standard measures and the new tasks of the ECB in the reformed European Monetary Union architecture. Since our meeting in July, we have received positive data for the euro area economy. Following 6 quarters of negative output growth, euro area GDP rose by 0.3% quarter on quarter in the second quarter of 2013. Measures of confidence and surveys of production have given some support to the view that euro area economic activity should continue its slow recovery in the current quarter, despite weak production data for July. Looking forward, economic activity should benefit from a gradual improvement in domestic demand, supported by the ECB's accommodative monetary policy stance and strengthening external demand for euro area exports. However, unemployment in the euro area remains far too high, and the recovery will need to be firmly established. Annual euro area inflation declined to 1.3% in August 2013, down from 1.6% in July. Underlying price pressures are expected to remain subdued, reflecting the broad-based weakness in aggregate demand and the modest pace of recovery. Medium to long-term inflation expectations continue to be firmly anchored in line with price stability. The risks to the outlook for price developments are expected to be still broadly balanced over the medium term. Monetary and in particular credit dynamics remain subdued. The annual rate of change of loans to the private sector, and notably to firms, weakened further in July. Weak loan dynamics continue to reflect the current stage of the business cycle, but also heightened credit risk and the ongoing adjustments in the balance sheets of borrowers and lenders. The significant improvement in the funding situation of banks since the summer of 2012 has not yet fed through into higher credit provision. Against this background, the Governing Council has pledged to maintain monetary policy accommodative for as long as necessary. In order to reaffirm and clarify this conditional pledge in a context of volatile money market interest rates, the ECB has introduced forward guidance in July, stating that it expects the key ECB interest rates to remain at present or lower levels for an extended period of time. This expectation, which has been reconfirmed in August and in September, is based on a subdued outlook for inflation extending into the medium term, given the broad-based weakness in the economy and subdued monetary dynamics. We will maintain the degree of monetary accommodation warranted by the outlook for price stability and aim at promoting stable money market conditions. To ensure an adequate transmission of monetary policy to the financing conditions in the broader economy, it is essential that effective measures be taken to further reduce fragmentation of euro area credit markets and to strengthen the resilience of banks where needed. Monetary policy contributes to these objectives, but it can only address impairments in transmission insofar as they are not related to more structural barriers. By giving unlimited access to central bank refinancing against adequate collateral, our non-standard measures have been pivotal in relieving bank funding stress. The collateral framework has been adjusted as necessary to ensure continued adequate risk protection for the ECB's balance sheet, while at the same time promoting transparency, for example, in markets for structured finance products. Ensuring that solvent banks remain liquid has contributed to avoiding an abrupt deleveraging which would have deeply damaged the economy. The outright monetary transactions, OMTs, announced a year ago have prevented risks of destructive scenarios with potentially severe challenges for price stability in the euro area. OMTs serve as a fully effective backstop within the ECB's mandate and under formal conditionality so as to preserve the appropriate incentives for governments to ensure fiscal solvency and adopt those structural policies that can put the economy on a sustainable path. Over the past 12 months, confidence in the euro area has returned. As a consequence, fragmentation in euro area funding markets has been receding. This improvement owes not only to the ECB's non-standard measures, but also to progress by governments in improving the euro area governance and in pursuing reform agendas. Deposit outflows from stressed countries have been reversed. Market access for banks has improved. Reliance on ECB funding support has been steadily declining. These improvements are reflected primarily in the ongoing advance repayments of funds by several banks which had borrowed from the ECB under the 2-3-year longer-term refinancing operations. While repayment of central bank credit is certainly a sign of normalization, the resulting reduction in excess liquidity can reinforce upward pressures on term money market rates. And we will remain particularly attentive to the implications that these developments may have for the stance of monetary policy. Let me finally address the tasks of the ECB in the reformed European Monetary Union architecture. The Maastricht setup has been substantially strengthened since the start of the crisis. Europe has reinforced fiscal and macroeconomic surveillance, created a permanent crisis management mechanism, the ESM, and has improved its institutional framework. It is moving swiftly towards the single supervisory mechanism for banks in the euro area. A key priority of the agenda for the last quarter of 2013 is to complement it by a single resolution authority and a single resolution fund, as proposed by the European Commission. The ECB strongly supports the envisaged timeline for the establishment of the SRM by January 1st, 2015, which adequately reflects the urgency. Let me make a few remarks on the specific role of the ECB in the progress towards a fully fledged banking union. Already in 2010, with the decisive contribution of your institution, the ESRB was created to oversee macroprudential risks in the financial system as a whole. The ECB ensures the Secretariat and thereby provides support to the ESRB. This year, a further reaching step is being made with the imminent launch of the single supervisory mechanism. The ECB is fully committed to assume its new responsibilities and to discharge accountability accordingly. Preparatory work has started in order to ensure that the new tasks are performed at the highest level of effectiveness and professionalism. While synergies between the new supervisory and existing monetary policy functions exist, the ECB will strictly respect the principle of separation between monetary policy and banking supervision as foreseen by the SSM regulation. Such separation will ensure that the ECB will continue to fulfill its primary mandate of price stability in complete independence in line with the treaty. The effective separation of monetary policy and bank supervision decisions will be implemented both at the decision-making level and at the technical staff level. A separate supervisory board will be created to draft and enforce decisions. Furthermore, the deliberations of the Governing Council on supervisory matters will be strictly separated from monetary policy decisions. This separation between the two tasks will be underpinned by separate agendas and meetings. Finally, let me say a few words on the involvement of the ECB in the Troika. Back in 2010, we were asked by the Council to provide our technical expertise to the design and monitoring of EU IMF financial assistance programs. In the meantime, the ECB has been allocated a number of specific tasks by the ESM Treaty and EU secondary legislation. We act in liaison with the Commission to provide technical advice based on our expertise. As we have done in the past, we remain ready to share our views on the situation in programme countries with the European Parliament and explain the advice provided as part of the Troika. However, it is important to recall that the Eurogroup is the body which actually decides whether to grant financial assistance and under which terms. Thank you for your attention. I'm now looking forward to your questions.
Thank you very much.
Thank you.
And thank you very much for your willingness to be as transparent as you can on issues relating to the Troika. That is something that concerns this committee, and of course it's not something that we can manage to achieve in a public sense vis-à-vis the IMF. So the fact that we can with the ECB is very welcome. We can move straight ahead, I think, to the questions. First for the EPP, Jean-Paul Gauzès.
Merci, Monsieur le Président, de ces...
Thank you. I could put a topical question to you, but it's perhaps a little early in the day to ask you what the possible consequences of Chancellor Merkel's re-election in Germany may be. As we wait for her to put her new government together, we should perhaps hang fire on that question. Now, may I just say that Parliament welcomes the interinstitutional agreement, which will ensure greater transparency for the wielding of your supervisory functions, albeit with the necessary provisions for confidentiality. But you're now moving into the more difficult period of actually implementing these procedures. They look promising on paper. For the ECB and the ESRB, you both would be covered. You talked about the need for a watertight Great Wall of China between the banking and supervisory board functions. Could I ask you about the precise time frame for the implementation, setting up the supervisory boards, given that this is vital if the banking union is actually to become a practical reality?
Thank you. Let me take your question as a broader question, asking for what's the state of our preparatory work for the SSM. And let me just say that we are watching with some degree of satisfaction that fast and sustained progress is being made towards the ECB readiness to assume its tasks under the SSM regulation. The ECB internal preparations are well underway, and progress to date has been fostered by the close cooperation between the ECB and the national supervisors. We have set up specific structures for preparing the SSM. We have the high-level group and the task force on supervision, a number of work streams comprising of senior experts from the national authorities, and the ECB have been established to conduct the preparatory work. In addition, to facilitate this preparatory phase, a total of 78 people have been seconded, cost-free, from the national supervisory authorities to the ECB. There are 4 key areas where this significant progress has been made. Let me just list the areas, and then later on I may get into some sort of greater detail. The first key area is the development of the supervisory manual. The second important area is the supervisory reporting. The third key area is the development of the SSM framework regulation. A fourth important area is the preparatory work to date on the comprehensive assessment, including a balance sheet assessment of all banks supervised directly, about 130 banking groups covering 85% of euro area bank assets. Then we have this assessment is based on 3 pillars: a risk assessment, a balance sheet assessment, and a stress test. Let me say finally something on the time frame. Significant progress achieved in recent months owes a lot to the hard work of the ECB and, as I said, also the national supervisors. So the time frame foresees the establishment of the SSM within the schedule that has been always foreseen by the regulation, namely 1 year since the approval of the legislation. And we will report to the European Parliament about the progress that we'll be making through a quarterly report, which is also going to be sent to the European Council and to the Commission.
Thank you. Oh, right. Actually, I've got a little note here from Adolfo, which now says that we are aiming for a possible vote in plenary in December on the appointment of the SSM chair and vice chair, if we can all get the procedures done in time. So that would be good to get us on our way. Now for the S&D, Elisa Ferreira.
Thank you, Chair. Signor Draghi, I'm going to... Sharon, can you stop the clock, please? Thank you. Signor Draghi.
Mr. Draghi, it's a great pleasure to see you here. I'd like to welcome you once again. Now, as I've said on previous occasions, I'd like to thank you for the European Central Bank for the work that you've made to try and save the euro with the OMTs. But the European Central Bank is also part of the Troika, and that's a very difficult model. In the case of a country like Portugal, Portugal has basically followed pretty much everything that was recommended, and they ended up with pretty much a recession that was twice as bad as what was forecast, with historically unprecedented unemployment and a debt that's a huge proportion of GDP. Sovereign debt is still at rates above 7%. So there are signs of recovery, but it's still too weak and too slow. So as a member of the Troika and as the issue of the OMTs, what can you tell us about the future? What can you tell a country like Portugal? My second question is on the role of the central bank as a single supervisor. Well, I've got 2 small questions for you. The first is on starting functioning. So, and when you're looking at the asset quality review, how can you do that without having a resolution mechanism in place first? And the second small question is on the Single Resolution Fund, which I'm the rapporteur for. This fund is going to be funded by the bank over 10 to 14 years. How can this be funded without a common backstop? Basically, some way to provide credit when necessary. This credit would have to be available from the moment when this fund entered into functioning. So otherwise, I think that success might be at stake. Thank you.
Thank you. On your question on Portugal, we are seeing, as you said, the first signs of a recovery. On the fiscal front, it's quite important, what I always say is that countries should not unravel the progress they've made on fiscal consolidation. So I don't think now it's the time to speak for extensions, but simply to continue. Now, having said that, fiscal consolidation, and here I repeat something I've said many times, ought to be growth-friendly, which means lower current expenditure and less use of taxation. Third, there should be full implementation of structural reforms. Some countries need to do structural reforms mostly in the realm of product and services markets and competition. Other countries need to do it first in the labor market. But continuation of structural reforms is absolutely essential to sustain the recovery, to sustain the redressment of imbalances across countries. Now, in the case of Portugal, there is also much to do in the realm of privatizations, and this is also something, is an area to keep in mind. But I would say that actually the recent history of shows that even the slightest signs of unraveling progress on fiscal consolidation cause markets to react brutally. You've seen the spreads. The spreads jumped at the minimum sign that something could go wrong, and they went back as fast as they had gone up. So it's not something that we can simply forget. Market discipline is there and will stay there, and we have to take that into account in what we do. The second point is how can we make an asset quality, I think the second question was how can we make an asset quality review without an SRM in place? Well, first of all, we still think that the SRM should be in place by the time the ECB will take up its tasks. So that we have to assign ourselves a pretty tight schedule for approving the SRM. But all in all, we have to use in this first stage mostly, if actually only, national backstops. So that's, I'm going to say more about that. For the asset quality review and the stress test to be credible, we'll have to have national backstops in place. The ECB will do its asset quality review in the process that we can discuss later, in the way that we can discuss later, and can reach its results, and the SRM, if it's there in place, it's better. If it's not there in place, it will be up to the national authorities to do and carry out this, which is suboptimal, of course. Finally, your point about what's going to backstop the SRM while the funding progresses. Let me say that the 10 years as a time horizon, the ECB thinks it's not ambitious enough. It's too long a period of time. And I also agree with you that in the meantime, there should be some backstop, some credit line, and it's not going to be a transfer because it's going to be recouped with the industry and refunded. But certainly it should be there. Thank you.
Thank you very much. Now for Aldi, Sylvie Goulard.
Bonjour, Monsieur le Président. Bienvenue.
Good afternoon, Mr. President, and welcome. The last part of your speech was intriguing. Do you intend to slowly and carefully withdraw from the Troika? I found it very interesting that you said that we would provide technical expertise, provide technical advice, the advice provided as part of the Troika. And you said it's the Eurogroup that takes decisions, and this is an important issue for citizens. Who decides on measures taken by the Troika? Are you just an advisor? Or does the Troika, which is an entity that has no legal basis in the treaties, does that take the decisions? And if it's the Eurogroup, to whom is the Eurogroup accountable? Thank you.
With the beginning of the crisis, I would say all actors suggested that the Troika be formed. And the ECB has fully and at the best of its competence provided with its own advice and expertise both governments, this institution, the Eurogroup, the Commission, the IMF. We view this role as lasting as long as this crisis goes on. But certainly in the long term, we don't view the ECB as part of the Troika. So that is the answer.
But in this case, who is deciding? What can I tell to the people who tell me just you say in the long term, but when will be the crisis over? And when can we decide that someone else is deciding, not just giving an advice?
Yes, indeed. The Troika doesn't decide. It's the Eurogroup that decides, because it's the Eurogroup that decides to finance the programs. The programs are being financed using national budgets with national contributions. It's national taxpayers that are being asked to pay taxes for these programs. So it's the Eurogroup that is the political institution, let's call it this way, that decides on the programs. The Troika has, at least as far as the ECB is concerned, an advisory role.
And the Eurogroup may or may not accept advice. Let's go on to the... Did you want to come back any more? Sylvie, did you want to come back any more?
Mr. President, but when I discuss with a group of children, I don't know who is responsible for the mess in the house. And this is a little bit the same feeling. Okay, that's it. Thank you.
But I like you call the Eurogroup a group of children. I mean, they'd be flattered.
Oh, dear. Yes, okay. I refer back to my previous comment. Right, now for the ECR, Dirk-Jan Epping.
Thank you, Madam President. The Fed, the Federal Reserve, decided not yet to reduce the pace of its quantitative easing purchases. It would instead wait for more signs of sustained economic progress before proceeding with tapering. Now, my question concerns the ECB equivalent of quantitative easing. In late 2011, the ECB started the LTRO program. It provided roughly €1 trillion in emergency 3-year loans to hundreds of European banks at low rates with low collateral standards. Earlier this month, the ECB's Money Market Contact Group called for a renewal of the LTRO loans, as the Wall Street Journal reported. Yesterday, Mr. Liikanen was quoted in the paper well known to you, Corriere della Sera, as saying that the ECB is ready to boost liquidity in the credit market by issuing another long-term loan if necessary. Now, the question is, can you comment on the recommendations of the ECB's Money Market Contact Group and on Mr. Liikanen's statement? Will the ECB launch a new round of LTRO loans, and under what circumstances? And it seems, I've got the impression that you are not tapering anytime soon. Thank you.
Thank you. Your impression is right. But let me say something on LTRO. The overall total voluntary repayments in both 3 years LTROs as of September 10th stood at 331 billion euros that correspond to 63.5% of the net liquidity injection at the beginning. Now, we have to, this is, on one hand, is a good sign because it shows that banks are less dependent on ECB financing and they can actually finance themselves either through the market or via deposits or exchanging credit lines between each other. On the other hand, markets watch this quantity called excess liquidity and may react increasing short-term money market rates. We have reacted to this issuing our own forward guidance, which is different from the one in US and in UK and in Japan. But also we are ready to use any instrument, including another LTRO if needed, to maintain the short-term money markets at the level that is warranted by our assessment of inflation in the medium term. Thank you.
Did you want to come back? No? No? Okay. In that case, we can move on to the Greens. Sven Giegold.
Well, welcome, President. I have a couple of questions concerning the state of implementation of the single supervisory mechanism. First, the regulation foresees strict separation between monetary and supervisory policy. You were reconfirming this principle here in very clear words. May I therefore ask whether there will be now, starting basically as of today, meetings of the supervisory body in the ECB in order to ensure that there is real separation also in the decision-making, or do you intend to wait until the chair and vice chair have been formally approved? Second, will there be clearly separate career path inside of the ECB so that staff on the supervisory side can dare to take decisions which might not be liked by the monetary side? Third, the regulation foresees strict quality asset balance sheet tests, asset tests and balance sheet tests. Could you confirm that whether government bonds will be stressed in the consequence of this exercise? And lastly, can you comment whether the ECB will make sure that the balance sheet assessments on the national level will not be done alone by national supervisors, but also by independent experts to control not only at the top level at the ECB, but also in the construction of the balance sheet, that the results will be free from conflict of interest? Thank you.
Thank you. Let me restate that the separation principle is fully enforced, that both our own experience at the ECB, but also for those central banks that have supervisory competence as well, they have the long-standing experience that the two functions can be carried out without infringing one upon another. One of your questions was about, yes, I can confirm that the asset quality review and the balance sheet assessment will be done by the ECB, by the national supervisors, by third-party supervisors. In other words, we do expect collaboration from, say, other member country supervisors, each other, and by private sector independent consultants.
This is a requirement for all member states?
Yes, indeed. Indeed. So there will be a series of consultants, there will be a series of tenders that they will, through which they will hire the consultants at national level. We also launched a tender for hiring a private sector consultant in the ECB, by the way. So you see, more generally, the asset quality review and the balance sheet assessments are useful only if they are credible. And to this extent, we should do everything that's necessary. That's our conviction. Otherwise, they're going to be completely useless, if not counterproductive. So I think one of the outcomes that we do expect from these tests, from the asset quality review, from the balance sheet assessment, from the risk that lies over banks' balance sheets in the euro area and in Europe. I think to some extent it's overdone, but the best way to respond is not to say that it's overdone, but simply shed light. And that's the way we consider, that's the way we want to do these tests. Let me also say that the outcome is as important as the process, because in order to reach this objective of clarifying this issue, we have to be exceedingly transparent in the process and make sure, as you said, that conflict of interest is dealt with at each stage of the process. So that's the way that the ECB views this, but I think the national supervisors as well. As I said, I made reference before to the very good relationship that has been created between the two, and it is fundamental to make progress on this. You also asked whether we are going to stress government bonds. We are sort of, we have to take decisions on this. It's not been discussed yet. The high-level group hasn't really coped with this issue yet. But as I said, we want to be absolutely credible. So the high-level group, which is basically the ex-ante supervisory board, will discuss this when we will make a communication on the asset quality review. We foresee the first communication by mid-October at the latest, where we will be coped with. On the supervisory body, you see, it's not the ECB that appoints the supervisory board. It's the member states. So it's up to them to appoint the supervisory board.
You can call the meetings, and so far you don't.
When we have, but they haven't been appointed yet. So what meeting should I call if there are no members? So
most members are there, and if the meetings are not called, there's no democratic control.
No, the democratic control is there. We report all the times about the high-level group. The high-level group is made up by most people who will be part of the supervisory board. Having said that, it's up to the member states to appoint the supervisory board members. It's not up to the ECB. So we are in their hands here. In the meantime, however, we want to move, and move fast and move well. We don't want to be clogged, trapped by these very important institutional steps. So the institutional steps will have to be taken, decisions have to be taken. In the meantime, we'll move forward. Thank you.
We've overrun a bit, but those were good and interesting questions. So we have to summon the Euro group if they don't get on with appointing. Now, for the GUI, Nikos Shuntis.
Madam Chair, my question is on the role the ECB plays within the Troika. This is something that you did focus on. Recently, the Greek Minister of the Economy stated that Greek debt has reached a level of 180% of GDP. That statement clearly refutes the responsibilities that had been mentioned. The Troika had mentioned a figure of 160%, but above and beyond that, the Troika had made a number of statements with different figures. In other words, the Troika, of which the ECB is part, was tackling the Greek recovery plan and was trying to work out what was missing from it. So, what are the third of the members of the Troika, that's to say the ECB's representatives, doing? Well, how do they think about it? Do they think that Greek indebtedness is sustainable? Do you have to bring the debt level below 100% to be sustainable? And what are you actually discussing in ECB? Are you discussing restructuring the debt? Do you have a range of possible scenarios?
Well, let me say that basically this question asks whether Greece needs a third program. And I think it's premature to ask this because the second adjustment program for Greece runs until the end of 2014 on the European side. And the IMF program will continue until early 2016. In our view, it's too early to already discuss now a possible follow-up program or an extension of the current one. And also, such decision will depend, for example, also on the extent of Greek market access at the end of next year, which is very hard to predict in advance. On the role of the ECB in the Troika, I think I've commented before. We, being the responsible for monetary policy, in a sense, it's good that we are part of the Troika at times of crisis. We don't provide financing under financial assistance program. And the ECB provides, however, considerable liquidity support to banks in Greece and in other countries. So we have incentive, we have a strong interest in being part of the Troika because this way we contribute with our expertise to the design and the monitoring of the programs. But as I said before, this is linked to the period of crisis. So I don't have much to add to what I said. Thank you.
Oh, yes, quickly.
Επιτρέψτε μου, κύριε Πρόεδρε, να επανέλθω στο αρχικό μου ερώτημα, το οποίο δεν απαντήθηκε.
I'm sorry, may I return to my first question? You haven't replied to that at all. In other words, what are the relations between the ECB and the other members of the Troika? The IMF is basically suggesting that Greek debt is unsustainable and is making proposals. But what do you think about that? What is your position? Do you think it's a sustainable level of debt if it's reached a figure of 180% of GDP? Do you think that's sustainable or not?
Frankly, we see no reason. The current assessment is that debt is sustainable, and we see absolutely no reason to change it.
I don't think you're going to get anything further on that. 180% debt appears to be sustainable, or whatever the current debt is sustainable. They may not be the same. EFD, Sampo Terho.
Kiitos, rouva puhemies.
Thank you, Madam President. Welcome again to our committee. Mr. Draghi, I would like to present a question about long-term policies. In the northern countries, the interest rate has been low for a long time, and you also mentioned that in your introduction how important accommodative policy is for a long time to come. Every time ECB makes decisions on the key policy rates so that they are low, then markets are rewarding it. If there is some suspicion, even the slightest suspicion, that the rates are going to rise, then the markets become to be nervous. I'm a little bit worried myself whether the present interest rate has become a normality, a state that markets are expecting to continue, that it is normal. So I'm asking, in what conditions we can start raising the rates again, and is it foreseeable even over the years? And therefore, I'm also worried that the present interest rate encourages leveraging and indebting, even though politically we want to avoid indebtedness as much as possible. Thank you.
Thank you. The current forward guidance says that interest rates will stay at the present or lower level for an extended period of time. This forward guidance is based on our medium-term inflation assessment. Inflation, as I said before, has gone down in August for the euro area. It's going down in August from 1.6 in July to 1.3. And it is expected to remain on below 2%, on the low side of 2% for an extended period of time. Given the weakness of the economy, the high unemployment. So given that this is our medium-term assessment, our monetary policy, which has as a mandate the maintaining of price stability, and I always say price stability in both directions, upward and downward, has issued this forward guidance. So we do expect the present or lower levels of interest rates for an extended period of time. At the same time, inflation expectations remain firmly anchored. So that's in a sense, that's the scenario, the economic scenario that we will have to face for, as I said, an extended period of time. Now, it's also true, and I think probably this is what is in the back of your question, it's also true that low interest rates for a long time entail risks. And we know this, and we've seen this in the past. So we are very sensitive to risks that could be there for financial stability stemming from a very low level of interest rates. And if we were to see them, we certainly would have to act through macroprudential instruments. This is the framework. So far, we see very, very, very limited evidence that this is the case. Thank you.
Right. I'm glad you mentioned macroprudential instruments. I'm hoping we'll come on to those. Did you wish to come back? No? Okay. Then for the EPP, happy-looking Werner Langen.
Ja, Herr Präsident.
Mr. President, well, the measures that the ECB has taken so far are something I've always supported very emphatically since you were the institution that performed best in this crisis. So I'd like to contradict the colleagues that have once again, for the 10th or 12th time, raised the problem of the Troika. I think that's absolutely necessary. However, I don't agree with everything that the ECB is doing, and therefore I'd like to pick up on what Mr. Giegold said. And I'd like to say a few things about the separation of money and supervisory policy. You said that there would be strict separation. In money policy, you're independent, but otherwise there has to be supervisory control, either by governments or by parliaments. And I don't think that's been fully discussed, how the supervision will be carried out, as long as there are problems in certain areas. Well, it was said that in December you decide on a president and a vice president. Well, you should already begin with the supervisory authority. And what's going to be the link to member state level authorities? And then what about the recovery fund that's supposed to be ready by January 2015? What do you say about Mr. Absusen's proposal to use the ESM up to that point? And then to anchor the fund in the ECB. Don't you think that would be rather dangerous? Because monetary and supervisory authority would be together in the same institution. And my final question, monetary policy. Well, the policy of the U.S. Fed and the Japanese Central Bank. Well, they're going for low interest rates and quantitative easing. And now we hear that low interest rates are a threat to pension systems, everything that make up the social welfare system in Europe. Are you going to try to have international discussions focused on going back to an interest rate-based system? Thank you.
Thank you. It certainly would be optimal to have this resolution fund be established not in 10 years, to be completed, not in 10 years' time, but with a shorter horizon. I would certainly agree with you that the ECB should have nothing to do with this fund. So but I don't know whether this crossed anybody's mind, really. The ECB should not and will not have anything to do with this fund. It's also true that during the period of time that the fund is basically underfunded, there should be the possibility for the fund to borrow money from some other source. And here a variety of possibilities is open, and frankly I think the reflection is still at its early stage. Some people have suggested that the ESM could extend a credit line to the resolution fund. I am not sure that this is possible within the existing treaty, but certainly the problem exists and will have to be addressed. On your second point about the members and the supervisory board, I can repeat what I said before. It's not up to the ECB to appoint the members. It's up to the member states. So when they will have appointed the supervisory board members, the supervisory board can actually be summoned and the advisory boards can take place. On the low interest rates, I certainly appreciate the concerns that low interest rates create, not only for financial stability, as I've said before, but for insurance, life insurance, for pensions, and more generally for the savers. All the savers see their savings being penalized by low interest rates for a long period of time. What we do here is to have monetary policy for the whole of the euro area. So that is one response. The second thing I think I would sort of call on you to watch the behavior of interest rates, especially in Germany, in the last 3 months, 4 months. They have gone up, even though our interest rates stayed the same. And the reason is that interest rates on the government bonds in Germany are low, have been for a long time artificially low, because Germany was the safe haven of capital flows from the rest of the euro area. Now, with confidence coming back, flows are not as strong as they were in the past, and so you see that other international movements can actually have the desired effect of raising interest rates on the government bonds in Germany. Now, we do have periodic discussions with other colleagues in the rest of the world. We do have discussions. These discussions don't reach the level of coordination, however. So there is exchange of information, there are discussions, especially, I would say, as far as issues linked to financial stability. Thank you.
Thank you. Now for the EPP, Pablo Zalba.
Gracias, Presidenta. Bienvenido, querido.
Thank you, Madam Chair. And welcome, President Draghi. I think that we agree that we see some positive signs of an economic recovery. And I'd like to go back to Mr. Ferreira on the case of Portugal. I agree with you also when you say that a banking union would allow us to accelerate that economic growth. But we have to ensure that this is something which is valid for the medium and long term. In the short term, of course, we still have the problem of credit and the issue of SMEs. I'm also wondering about the same issue as Mr. Langen, low interest rates. I don't think that this is going to have a real effect on the economy of any country at all. In my country,
there is a real problem with SMEs. 25% of SMEs give access to credit as their main problem. That doesn't mean, however, that the others don't have any problems with gaining access to credit at all. And credit is still more expensive for Spanish SMEs than SMEs in other countries. We talked about the fact that the ECB has as one of its missions to inject liquidity into the market. But I'd just like to know, if we provide that liquidity, how can we ensure that this additional liquidity will really help the real economy and will not simply be used to buy up public debt? So how can we ensure that if additional liquidity is actually provided, that additional liquidity will get to the real economy and not end up elsewhere?
Let me first agree with you that the SMEs are the backbone of our economies, especially, I would say, in those countries that have been affected by the crisis. And I would also agree with you that during this crisis, financing obstacles have increased for the SMEs. In part, these obstacles were driven by the deterioration of their financial situation. We shouldn't forget that many SMEs are highly leveraged, meaning that their existing debt is pretty high. But certainly there have been other factors, and one of them is the risk aversion by banks. The so-called rate of return on lending adjusted for risk in many of the stressed countries is just not high enough for banks to be persuaded to lend to SMEs. And as you said, some of them buy government bonds instead of financing the real economy. But the other reason, which we still think is predominant, so we have basically weakness of the balance sheets of the SMEs, we have risk aversion by the banks, but the other reason is really lack of demand. There has been a survey of SMEs credit flows. We do two types of surveys. One is the bank lending survey, which basically asks the banks why they don't lend. And then we also do less frequently, a survey on the other side, namely asking the SMEs why don't they borrow. And the first reason they quoted for not borrowing was basically lack of clients. And the second reason was lack of banks' credit supply. So the most important reason that we see now as still depressing the credit flows is basically lack of demand. However, we've taken many measures, really. If you compare, often people compare our programs with the Funding for Lending program in the UK, we see that the components, namely a wide array of counterparties, a wider variety of collateral, and long maturity. These are the three components of the funding for lending, and these are also the three components of our LTROs. We've been having this in place since the end of 2011. So we've taken several measures. More recently, we've decided a lowering of rating requirements for some asset-backed securities, including those assets backed by SME loans. We've decided the setting up of additional credit claims so that banks can actually take the credits they make to their clients as a collateral when they come to the ECB for borrowing money. And also, very recently, in July 2000 this year, when we discussed, and we do these discussions periodically, we discussed the permanent collateral framework. We decided to introduce measures that could support SME financing, like a reduction of ABS haircuts besides a reduction of ABS rating requirements. Finally, we are still working with the EIB and with the Commission for structuring and revamping the ABS market so as to further support the SMEs. In this, the ECB has, for the time being, a purely advisory role. Thank you.
Thank you. Our questions are getting a bit too long. Now for the S&D, Annie Podimata.
Ευχαριστώ πολύ, κυρία Πρόεδρε, κύριε Πρόεδρε.
Thank you, Madam Chair. President, I'd like to take a moment on the low interest rates. I have other concerns to Mr. Langen's. Our colleague mentioned the position in Spain, whereas Mr. Langen, in a number of countries, there's a huge problem with the lack of liquidity, with there being huge gaps in the interest rates being paid for loans from one Eurozone member state to another. While in Germany you might be able to borrow 2% in my country, and others you would be borrowing at 4 to 5%, and others it's as much as 7 or 8%. That's perfectly true. Now, allow me to put it to you, Mr. Draghi, that for a year now, 3 of the largest Greek firms, SMEs were referred to a little while ago, but anyway, 3 major Greek firms have switched their headquarters abroad in order to seek funding. And Miokalka, the largest firm in the country last week, switched its headquarters to Belgium so that it would have access to the financial markets. Now, given that this is a problem linked up to your point, that's to say, the transposition of monetary policy, this isn't something specific to Greece or Spain. Could I ask you what you have in mind to avoid a 2-speed Eurozone emerging when it comes to that transposition of monetary policy?
Well, let me try to give a picture of how fragmentation looks like today. At the beginning of the crisis, we have to look at fragmentation on both sides, funding and lending. At the beginning of the crisis, we had both. We had the banks placed in stressed countries that had funding costs way higher than banks placed in core countries. And we had liquidity flows which were way lower in the stressed countries than in other countries. That is by and large overcome. What we have seen over the last, I would say, 6 months, we've seen that deposits, with the return of confidence, domestic deposits went back to their domestic banks. What we do there is we look at how deposits grow in each country, and we compute a dispersion coefficient, and we've seen that this dispersion between the growth rates of deposits in different parts of the euro area is now at the same level as it was in 2007. So, the bottom line of this is that funding through deposits fragmentation is by and large gone. Now, other forms of funding, when banks have to access wholesale market issuing bonds, that is not completely gone. But certainly we've noticed a shrinking of the funding spreads. On the lending side, the progress is admittedly much, much slower. And even though, again, we see a decrease of dispersion between lending rates in different parts of the euro area, we see the conditions are still different. And I think there are also good reasons for that. If you consider the risk premium of lending in a stressed country to a firm placed in a stressed country vis-à-vis the risk premium for lending to a firm placed in a non-stressed country, you have a big difference by itself. Second, government bonds yield different rates. So I think someone of the previous speakers was actually hinting at that. Banks often, rather than lending to the economy, they simply buy government bonds. They have much less risk and they have a return which is okay for their profitability. So there are issues like that, but again, the key reason is demand. We see that gradually our accommodative monetary policy feeds through the economy, and gradually the system is recovering. As the recovery will proceed, we will see fragmentation on the lending side as well going down and shrinking. It will become less risky to lend to companies. Thank you.
Of course, if government bonds weren't zero risk, we'd have a happy little rebalancing of the money going back to the economy instead of being in government bonds, perhaps. Now we'll go to the EPP and Astrid Lulling.
Merci, Madame la Présidente, Monsieur le Président.
Thank you, President, Madam Chairman. Your colleagues on the board, who include my compatriot, Mr. Mersch, and I'm very pleased to see that he's putting his experience to use and to the service of the ECB after the problems he's had. Mr. Mersch has just made some very interesting statements to the press concerning the implementation of the single banking supervisory mechanism. The supervision that will cover the 130 banks will soon be operational. That's what you've confirmed. But there's a problem, a very important one, that remains to be dealt with. That's the issue of the backstop, as it's called. What's necessary is to determine how the recapitalization that's necessary will be spread among the various governments. If there are serious gaps in the balance sheet of a bank were to appear. I'd like to explain to you that what's at stake here is very important. Let me explain this in detail. The resolution fund, which is currently on the agenda, is something where I need an explanation. What's the connection between the backstop issue on the one hand and resolution on the other? Are they complementary? Are they the same thing? Or are they two fundamentally different things? I haven't really understood that. Another question. In a very interesting book that's just been published, François Langlais, a journalist and economist, explains that globalization is suffering a downward trend. There are significant regressions, particularly in the Eurozone, and that's been seen since 2007. No, globalization is on the way out. If this were to prove true, what about flows of international capital into the Eurozone? Would that be a problem in itself, in particular for the management of the single currency? Thank you.
Thank you. I will answer first the second question. Frankly, we don't see globalization going down. And if we watch what's happened with the capital flows since the beginning of the year, we see that actually it's just the other way around. Capital flows continue to travel freely in different parts of the world, creating different monetary conditions, generally changing interest rates and exchange rates. look at what's happened since the Fed is communicating the possibility of tapering or not tapering. You had flows before you had massive flows to emerging markets and also significant flows into the euro area. Then when the tapering possibility emerged, you had massive outflows from emerging markets, though the euro area was not really affected. So capital flows are still very, very mobile, and globalization is not going down. The first question is about the SRM. Let me say that the ECB was formally consulted on the SRM proposal earlier this month, and an official ECB opinion will be published. Now, let me reiterate, the SRM is a necessary complement to the SSM. It's important that the levels of responsibility and decision-making for supervision and resolution are aligned in order to achieve a well-functioning financial market union. So the ECB welcomes the Commission's proposal for the SRM, which contains the three essential elements: a single system, a single authority, and a single fund. We also strongly support the envisaged timeline for the SRM on January 1st, 2015. I've also had the opportunity to comment that the two roles of assessment the viability of a bank and taking care of its resolution should be separate. The ECB, as a supervisor, will do the assessment, but everything else would have to be done by the SRM. As far as the role of the ECB in the SRM, the view of the ECB is that its presence should only be the one of an observer. Finally, on a legal basis, I understand from the legal services of the ECB that Article 114 of the treaty is indeed an appropriate possible basis for the proposed ESRM regulation. I understand also that this view is shared among the legal services of all EU institutions. And the legal service of the Council also has informed that Article 114 is sufficient. Now, on the backstop, the same word is being used for different meanings, really. What we refer as a backstop in the context of the SRM is the fact that this fund, the single fund of the SRM, will take 10 years to be completed. So the issue is, what happens if before the end of the 10 years we have need of this fund? And then the possibility for this fund to borrow money, not money for free, to borrow money from another source ought to be there. That is what is called the backstop for the SRM. The possibility of having for the SRM a credit line where they can draw in case there wasn't enough in the fund itself.
Right, thank you. Now for the S&D, Emily Turnen.
Thank you. First of all, a comment. I think what you said about your relations to other central banks was interesting. You said basically that you have some discussions, but not really any formalized decision-making structure. And I think it just a comment. I think it points to a major flaw of our cleaning up after the crisis, that we still have not put in place a global financial architecture. But that was just a comment. So my question is on your new role as supervisor, one of today's topics, and something that I've asked others before, but that I still have not had a good answer to. So it's about the asset quality review. Mr. Dijsselbloem was here some weeks ago, and he said that the quality of the asset quality review is very important, and we of course agree to that. That's clear. And you have talked about credibility today. But he did not have any concrete proposals on how to ensure this, not only the quality of the methods used, but also the independence of the experts used. So my question is, how will you ensure the high quality, especially in light of the criticism after the last stress tests carried out on methods? And secondly, how will you ensure independence, especially among the private sector experts? And how do you define independence in this case? And you said about backstops, that there should be national backstops in place. And my question is, are they in place? Is it realistic for Spain, Greece, maybe even France?
First, let me say the comprehensive assessment will be based on a thorough and rigorous methodology. This methodology is currently in preparation in the context of the SSM preparations. These preparations, as I said before, will be supported by the advice from experienced external consultants. And the ECB, as I said before, has launched a tender and has hired an external consultant. Second, a carefully crafted, centrally led, that's key, project management function will be established to ensure that this robust methodology will be applied consistently and independently across all banks that fall within the scope of the exercise. So it's important, centrally led, should be consistently and independently applied to ensure that it doesn't become fragmented and that the results are fully comparable. This effort will be supported by experienced external project managers. Critical process management and quality assurance will be interwoven with every step of the methodology to guard the credibility of the process and of its outcomes. Now, on the backstops, well, we have to take into account, first of all, that the banks, in the meantime, have raised considerably their level of provisionings. And so the role for the national backstops is there, and it's realistic, also for the countries that you mentioned. Thank you.
Okay, thank you. I think, Emily, I thought that Minister Dijsselbloem was quite categoric about the use of consultants throughout and also about the bail-in hierarchy. I mean, maybe one could poke holes in some of his responses, but I thought that he was quite strong on that point. Now, where am I going? To the EPP and Marianne Thyssen.
Thank you. Dank u wel, voorzitter.
Thank you, Madam.
Aan de voorzitter van de Europese Centrale Bank uiteraard.
Thank you. And thank you, President Draghi, for being here from the ECB today. I would like to express the following reservations and ask some questions, President. We have come a long way with all of the institutions together. We've produced a lot of legislation, taken a lot of political decisions, a lot of standard and non-standard measures have been taken, and I think that we have gone a long way towards ensuring that future such crises can be avoided and that we are getting the train on the right track to prevent such crises again in the future and to create more confidence. But we haven't completely finished that work. We have the SRM that hasn't been completed yet. And my question is, when you start your asset quality review and other quality tests of the bank, there's always the risk, and I think we have to bear that in mind, that problems may crop up here and there. And that raises the question in my mind of how we are going to ensure that the first piece of negative news that comes out will not trigger a panic reaction and once again lead to chaos. How can we avoid that? Is that something that you're aware of, that the lack of confidence that we have at the moment means that we don't have sufficient resilience in the economy and in the financial markets? So who's going to step in here? Is this something that is being discussed between the institutions? I put this question to Commissioner Barnier, and he told me that he had raised it with the finance ministers at the last ECOFIN Council, that we have to have communication about this issue and that people need to be aware of this and they shouldn't be surprised if some negative news does emerge. But is the ECB preparing for this? Can communication make us more resilient, and who is going to take this responsibility, or are my concerns unfounded?
No, your concerns are really well-founded. They are not unfounded at all. We do share them, and we are aware that we have to cope with them and be prepared. The past experience is also quite instructive. Now, things may be slightly better now this time, both because banks have significantly increased provisionings. They have raised significant amount of capital. So the overall situation, and generally speaking, there is much more confidence around than at the time the previous stress tests have been made. But our assessment will be comprehensive and stringent, and because we need a clear overview of all the significant entities for which we are going to perform the task of the supervisor. It's too early to say what figure can come out. So we do believe that this assessment will increase in transparency, will actually increase confidence, provided we are ready to cope with the shortfalls. That's why I've been insisting on the importance of national backstops since the very beginning. They are absolutely essential to ensure the credibility of the asset quality review and the stress tests. If there are no national backstops, the world will say, these figures have come out the way they are because of the fear of coming out with worse figures in absence of national backstops. That's why they are absolutely essential to give credibility to the exercise. And so that's what we are trying to do, to be as transparent as possible, stringent, consistent across the board, independent application, but be ready to intervene. Thank you.
Thank you. Now for ALDE, it's Ramon Tremosa.
Thank you very much, Madam Chair. Mr. Draghi, good afternoon. Two questions. The first one concerning banking union. The ECB is going to supervise some European banks, and for me, as a Catalan MEP, this is a good news that all Spanish banks will be under European supervision. But a question is, who should pay for the mistakes in supervision of the ECB? The second question, concerning the ECB supervision. I believe that there is no supervision credibility without failures. Credibility requires that some banks fail. The ECB should have the red button to force the failure of a bank, because now we see that in some member states there are banks that are declared too big to fail, and this means huge losses for taxpayers and social cuts. And in other member states that there are quite large banks, for instance, Germany, the West Landesbanken, that are forced to fail. So who should have the red button to force the failure of a bank? Thank you.
Thank you. Well, on the first question, I really don't want even to think about on who should pay if the ECB makes a mistake. But the second point is actually very important. We said since the very beginning that the moment to assess the viability of a certain financial institution and how to take care about that institution are two different moments, different tasks, and should be performed by different institutions. So the ECB will tell the SRM that a certain institution may not be viable. Then it's up to the SRM, very much like it is with the FDIC in the United States, to decide what to do with this institution. It can be sold, it can be recapitalized, it can be merged, it can be dissolved. So there are many different ways. But since all these different possibilities may have an influence on the national budgets, on the taxpayers' money, it should be completely different, the task, from the supervisor's task. And that's, by the way, that's how it works in different countries nowadays. You have the supervisor who basically tells the budget authority, the finance ministry or the treasury, that a certain institution is not viable and ought to be either resolved or taken care, namely sold or merged with others. And the two tasks are kept separate, as far as I know, in all member countries. Thank you.
Did you want to come back, Ramon? If I may, these are some of the issues that we are discussing as well in the trialogue on the Resolution and Recovery Directive in terms of how much flexibility there should be for different banks to be resolved in different way. And the Parliament wants a presumptive path for investors and rather less different outcomes. So, but that's something that is still under negotiation. Mario, I've got a question for you about macroprudential policy and the ECB. I mean, obviously, macroprudential policy, which you know is an important new tool, can be exercised by the ECB when it takes over as the competent authority in the SSM, but there's also a side to macroprudential policy that would impact on the monetary policy side in terms of trying to cope with the fact that one interest rate for all member states doesn't work, and therefore pressing on the banks and the bank lending and such like is another way of doing it. Who's going to be doing this, and how is the, if you like, the macroprudential policy going to be dealt with when it does bridge across, if you like, the sort of supervisory side and the monetary policy side? And you haven't got a sort of middle body that would be calling the shots, whereas in the Bank of England they've got a kind of middle body looking both ways that does it. How will you cope with that within the ECB?
Well, we're actually working on this. The macroprudential policy, it's going to be, basically it's going to be falling both within the supervisory board tasks and the governing council tasks. And we are in the process actually of finalizing ways of cooperating with special meetings on this point, with an interchange of information. So we are in the process now exactly of finding the right arrangement for this. Also keep in mind that in the ECB we have the financial stability part that will also deal with this. It's something, it's a concern that is well present in our minds, and we have to be ready to provide the euro area with a reasonable way of handling this. It's an area that is admittedly grey, where you can, however, in our case, it's in a sense the task of keeping separate monetary policy from macroprudential policy is made easier by our treaty. You know that our primary mandate is to keep price stability in the medium term. So that makes our task easier, because we know that no matter what, the primary mandate is the first and foremost mandate that we have to comply with. Having said that, you may have local problems. We view macroprudential policy in an area as complex as the euro area is as a way to cope with local problems, localized bubbles in different, for example, in different parts of the euro area. But that doesn't have an impact directly on monetary policy.
And would that be then the ECB proper doing that, though, or would it be the ECB through the supervisory?
We are discussing exactly who does what in these days, exactly.
Okay, sorry to put my finger on a difficult point. We've got a little bit of time, and I know Mr. Bokros has been waving at me. He's not on the list for a question, but you have a question? Yeah, okay.
Thank you, Madam Chair. In July 2012, Mr. President, you made a historic statement saying that the ECB will make whatever it takes to save the euro. We can call it forward guidance because it had a major, tremendous positive impact, but not on monetary policy, on fiscal policy rather. It saved many sovereigns from going bankrupt. While at the same time, as it was discussed already, the monetary transmission mechanism is not perfect, really, because there is very little credit growth and very little real growth in the economy. Is it not an irony of history that these kind of forward guidance statements are much more effective as a backstop to fiscal policy rather than helping the real economy in terms of monetary policy? Thank you.
I would agree with you that the OMT has been extremely effective. I wouldn't agree with you that it's been effective as a fiscal backstop at all. OMT is an instrument of monetary policy. We should remember that at the time, the risks that we were addressing through OMT were the risks of redenomination, which was a euphemism for indicating highly disruptive scenarios for the existence itself of the euro. And some of the interest rates that we were seeing prevailing in the euro area were not justified by fundamentals, but simply by this self-fulfilling expectation of a dissolution of the euro. And that's what the OMT addressed at that time. And this was a monetary policy objective because such disruptive scenarios were impairing our achieving of our primary mandate, namely price stability in the medium term. So that was the objective. Having said that, you know the conditions for actually activating OMT, and these are stringent conditions on the macroeconomic program with the possibility of a primary market purchase by the country that is asking for it. So there was no, I would say, no intention at all to address the fiscal problems of different countries. The underlying conviction is and was that if a country has an unsustainable fiscal position, there is nothing one can do to make it sustainable other than the country itself. And sustainability ought to be valued at interest rates that reflect the underlying fundamentals. I think that was at the root of the OMT design. Thank you.
Okay, I'll take one more question now from Philippe Lamberts, and then we can have a short break, which Mario has asked for before the next part of the hearing, which will be on the European Systemic Risk Board. Philippe.
I took from Sharon look at me that it should be short, so it will.
Mr. President, you mentioned that lending to the real economy did not match the rate of return expectation of the financial industry. Wouldn't you agree with the fact that the financial industry has been addicted to rates of returns that are incompatible with a stable economy?
Yes, indeed. Yes, indeed. And just to follow up on this point, you see, part of what we are seeing today is that all the regulation that we've been putting into place since the financial crisis, and we are continue to doing so, is meant to make the banking system and generally the financial system less risky than it was before. So one would think that, yes, the rates of return are lower today than they were before, because we knew, as you said, they were addicted to a rate of return which was not sustainable through time. However, being the rate of return lower, you also have lower risk nowadays. But it's taking time. It's taking time for the markets, for the financial industry to appreciate this fact that rates of return are going to be and stay lower. At the same time, risk is also lower. So it's a different combination of risk-return that people should start appreciating. And I think, of course, the situation today is way better than it was 3 years ago. As you've seen, banks now can again raise capital on the markets. The overall situation has improved from a confidence viewpoint. So gradually it seems that the shareholders are understanding this new configuration of lower rate of return and lower risk, and they are responding consequently. But here it comes, what I was saying before about the asset quality review comes into play, and it's very, very important, because in order to convince the private sector to invest in the banking industry, one not only needs lower risk, but also one needs transparency on the bank's balance sheets. That's why the asset quality review may turn out to be very important in reactivating the credit flows of the banking sector to the real economy. Thank you.
Right, thank you very much. So, thank you. That brings us to the end of the sort of monetary policy side of things. As requested, we'll take a short break now for about 5 minutes, and then we can start the next session probably a few minutes early, but then that allows Mario to get away to get a plane. So, back in 5 minutes, please.
Thank you.
Right, welcome back, colleagues. We are now going on to the hearing, still with the President of the ECB, but this time in his role as Chairman of the European Systemic Risk Board. So again, we'll have a few comments from Mario in that capacity, and then on to the ESRB question and answer session. Mario.
Thank you, Madam Chair, honourable members. It is a pleasure for me to appear before this committee today in order to inform you about the activities of the European Systemic Risk Board. First, let me say that in the course of last meeting, Governor Carney, Bank of England, was named first Vice Chair of the ESRB. Since we last met, there have been signs of a gradual turnaround in Europe's economic outlook. While these developments are encouraging and still, as I had the chance to say many times, in their infancy, risks to financial stability, of course, remain. In my remarks today, I will report on the work the ESRB is undertaking to address some of these risks in the fields of insurance, banking, and market infrastructures. I will also report on two other areas of ongoing work: the assessment of the implementation of the ESRB first recommendation and its guidance on the use of macroprudential instruments to assist national authorities. The insurance sector plays an important role both in the financial system and in the economy at large. Apart from assuming risks that households or firms do not want to bear themselves, it also acts as an investor. At the same time, there is a need to deal with possible risks and vulnerabilities that stem from insurance, some of which have the potential to affect the stability of the financial system. Life insurance companies, especially those that promise guaranteed returns, are suffering on account of the current environment of low interest rates. Looking at this from a microprudential point of view, EIOPA has correctly advised firms to modify their business models. This is crucial for addressing the issue at its economic source. If business models are not modified, insurance companies could search for higher yields by investing in riskier assets. But this would expose them to potential losses through increases in risk premia. Firms have limited incentives to address these vulnerabilities if regulatory regimes do not bring them to light. A failure to do so would weaken the sector's ability to fulfill the important role it has to play in the economy. Spillovers to the wider financial system through direct linkages and common exposures cannot be ruled out. Awareness that the insurance sector may be of systemic relevance has grown. At the international level, the Financial Stability Board has recently announced a list of systemically important global insurers. 5 out of 9 are European. The International Association of Insurance Supervisors has developed a framework for policy responses, including effective resolution and a higher loss absorption capacity. In the United States, systemically important financial institutions, including insurance companies, will become subject to consolidated supervision by the Board of Governors of the Federal Reserve System and to enhanced prudential standards. In Europe, work to finalize the new system of prudential regulation, Solvency II, is continuing. In this respect, the European Parliament is playing an essential role in its capacity as co-legislator. Solvency II reflects the risk profile of insurers better than Solvency I, and it enhances their risk management capacity. At the same time, the new system should deal with possible unintended consequences of excessive short-term market volatility, including pro-cyclical effects, as the currently debated long-term guarantee package aims to do. As requested by the European Parliament, the ESRB has participated in the economic assessment of that package undertaken by EIOPA and supports the main conclusions reached. Given the issues I have just emphasized, it is crucial that this package ensures both adequate capital levels at all times and full transparency of their application. All risks should be addressed appropriately. The banking system plays a crucial role in the financing of the economy. At the same time, its role in the unfolding of the financial crisis has highlighted a number of vulnerabilities. Important steps are being taken to address these vulnerabilities and to deliver the healthier banking system that European citizens deserve. This, too, is an area in which this Parliament has played a major role, approving the regulation on the single supervisory mechanism. The forthcoming comprehensive bank assessment conducted by the ECB, conducted in a way consistent with EBA recommendations, announced in March this year, has the potential to strengthen the confidence on the soundness of the banks within the single supervisory mechanism. That, in turn, would reduce banks' funding costs and lower the cost of credit for firms and households. This requires clear communication, as well as credible and effective ex-ante mechanisms, including fiscal backstops, wherever needed, for absorbing any capital shortfalls that such a review might reveal. At the ESRB, we are looking at two structural features of the European banking system that the financial crisis has highlighted. First, the large size of the banking system relative to the real economy, and second, the concentration of losses in certain lending segments. In many countries, the rapid growth of bank assets with the support of increased leverage proved to be unsustainable. Once credit losses materialized, some sovereigns that had to support their banking system came under pressure, and deleveraging constrained the extension of credit to the real economy. This amplified the crisis during the downturn and continues to weigh on the recovery. Against this background, the ESRB's General Board is continuing to reflect on how the size of the banking sector relative to the economy affects the supply of socially beneficial financial services. The Advisory Scientific Committee has likewise started to work on this issue. During the crisis, banks' losses were often concentrated in certain lending segments. In a number of countries, losses on property loans have required large-scale public sector intervention in the banking system. But even niche segments, such as shipping finance, have required intervention in individual banks in some countries. Cyclical sectors to which banks have high exposures in the European Union include construction and property, consumer durables, mainly the automobile industry, and materials and fabrication, mainly steel and chemicals. The ESRB is conducting further work in this field. I'll now turn to the role of central counterparties, CCPs, which form a crucial part of the EU financial system. As you know, the G20 countries have agreed that all standardized over-the-counter derivatives should be cleared through such counterparties. While CCPs offer a number of economic and risk-reducing benefits, they are also becoming systematically relevant nodes in the financial system. This entails a number of macroprudential risks. The procyclicality of CCP's margin rules and practices is a key concern. Increasing margin requirements in times of stress and decreasing them in good times may make sense from the perspective of an individual CCP, but also carries the risk of increasing the cyclical sensitivity of the financial system. These vulnerabilities may grow with the importance of CCPs. While ESMA has already incorporated some helpful provisions into its technical standards, their effectiveness from a macroprudential perspective might be enhanced through additional mitigating measures of a countercyclical nature. CCPs also need robust recovery plans and resolution regimes in order to avoid a disorderly insolvency. Finally, there is also the risk of contagion, particularly across CCPs that clear the same products under the so-called interoperability arrangements. Evolving CCP markets need to be designed in such a manner that limits the spillovers of potential distress at one CCP to another. To this end, specific guidelines have been already issued by ESMA. Nevertheless, given the systemic importance of CCPs, it is important that there is a broad set of tools available to increase their resilience to contagion. EU legislation has provided the ESRB with a clear role in these areas. For example, under the provisions of the European Market Infrastructure Regulation, EMIR, the ESRB has been asked to examine the potentially exacerbating impact that the procyclicality of margin practices at CCPs may have, and to monitor the design of interoperability arrangements. The ESRB considered these issues at its latest General Board meeting and has commissioned further work. Let me also update you on two items of ongoing work. First, the assessment of the implementation of the ESRB's first recommendation. As you know, ESRB recommendations are soft tools, accompanied by an act or explain mechanism. Thus, from an accountability perspective, it is important to assess the actions of member states, including possible explanations for their inaction, after an ESRB recommendation has been issued. For its first recommendation on lending in foreign currency, the ESRB has just completed the first full cycle from the issuance of a recommendation to the assessment of its implementation. As you may remember, the recommendation sets out a series of measures to tackle possible systemic risks of lending in foreign currency to the non-financial private sector. The ESRB's General Board is in the process of finalizing its assessment, which will be published in the next few weeks, and looks forward to applying a similar procedure to the next assessments of the ESRB recommendations. The second item relates to the guidance on the use of macroprudential instruments provided for in the recently approved European Capital Rules. As you know, the new European Capital Rules will start entering into force in 2014. They provide for a range of macroprudential instruments that national authorities will be able to deploy. As I mentioned to you at my previous hearing on July the 8th, the ESRB is working with Member States on guidance on how national authorities can use these instruments in a coordinated manner. I'll provide you with more details on this matter at the next hearing. Thank you very much for your attention. I'm now available for questions.
Thank you very much. And thank you for telling us about the appointment of the new first Vice Chair. We are already investigating when we can have a hearing with the Vice Chairs. It's likely to be early next year due to the workload of this committee and also diaries of other people, but we will be doing that as before. As you've mentioned insurance, and quite a lot of us are working quite hard to try and get Solvency II finished within the framework of the Omnibus 2 proposals. I won't tax you on the details of that, but in the systemic context, are insurance companies becoming more systemic because they are now threatened with bail-in under bank resolution and recovery, whereas previously there would have been the implicit guarantee to the banks? So does that move them up the systemic risk agenda?
Well, the concept of being systemic is different in banking and insurance. For banking, the being systemic is linked to the possibility of bank runs and possible transformation of liquidity problems into solvency problems. For insurance, being systemic is linked to the possibility that a certain economic function, like risk diversification, would disappear. For example, no reinsurance anymore. Moreover, vulnerabilities in the insurance sector would translate themselves into a lack of long-term investment in the economy, or in the worst case, in pro-cyclical fire sales. Based on this, work is ongoing at international levels, both in the FSB and in the IAIS, to set up a macro-prudential view of insurance vulnerabilities. Major systemic players have been recently identified, as I was saying before, by the FSB, IAIS, and as I was saying, 5 out of 9 are European. In conclusion, I think insurance is systemic, but differently from banks, and not necessarily because of the potential bail-ins that you were referring to, but certainly that is also a dimension that we have to consider.
Okay.
Thank you.
If I can press you on a slightly related but different point, you mentioned long-term investment, and there are now various proposals around to try and get insurance and pensions firms more interested in long-term investment, but they are demanding that there be some kind of guarantee, whether it be from the EIB or elsewhere. So if we end up putting in essentially governmental guarantees onto long-term investment that's in insurance companies, have we not just transferred what was a subsidy to banks to do long-term investment and other things into a subsidy for insurance companies or an underwriting?
This function of being a long-term investor for the insurance companies has been a long-standing one. And so, and that's in a sense the good side to this, that they provide an anti-cyclical role. So they are the typical institutional investors, which are crucial for financing infrastructure investments, which are typically long-term. And they do play a role against the short-termism in the economy. So even without guarantees, I should say that recently there has been a tendency of large insurers to enter into more medium and short-term lending originating loans. So this might help assuaging risks of global credit crunch at the time when banks have problems lending. But it should be supported by adequate risk management and capacity to price risk. So I'm not sure that the insurance sector does need supplementary guarantees to undertake the same type of investment it's always been taking in the past.
Okay, so they're asking they may not get then. And now we'll move on to the EPP and question by Diogo Feo.
Muito obrigado, Sharon. Sr. Presidente Draghi, queria começar.
Welcome, Mr. Draghi. May I tell you that I welcome what you said in your presentation, particularly regarding the importance of the banking system for the economies of EU member states. One of the elements that's very relevant here is the level of confidence savers can have in the system. If we're already working well within the banking union on the SSM, we still have work to do on resolution and deposit guarantees. When our citizens and firms realized that the principle of the bail-in was there, regarding the 100,000 euros savings limits new position under the hierarchy, I had to reassure them. So could I ask you, Mr. Draghi, whether you have any solutions which at the right time will provide confidence for European savers?
Well, at the general level, the best support of European saving is the return of confidence in the economy and the establishment of a firm recovery. Within the specific context of a resolution, we have to distinguish between going concerns and gone concerns. For the gone concerns, we have a well-defined pecking order where we have said several times that there should be depositor preference on one hand and bail-in of the equity on the other hand. In between, we will have different categories of creditors, and then we have the going concerns where we ought to be extremely careful in thinking about bail-in when the bank is still viable. The best answer to this situation is to have a certain set of instruments by the going concerns, issued by the going concerns, that would be called in case certain conditions were to materialize. That's why the role of supervisors is also important from this viewpoint. Thank you.
Did you want to come back?
Muito obrigado. Sharon,
Thank you. I'd like to take this opportunity to ask you for a comment regarding a situation I discovered recently. I'm Portuguese, and a Portuguese non-financial firm in December 2012 had to pay on average 6.2% to get a loan, whereas in other EU member states, firms are paying interest rates which are only a third of that. What do you think can be done to overcome that situation?
This situation is the product of a financial crisis that has created fragmentation in the euro area. And though on the funding cost side, we've seen significant improvements for the banks, we've seen a more limited improvement on the lending side. And we still see that lending costs differ across different countries. This partly has to do, however, with the fact that we have to accept that the risks of lending in the stressed economies is higher than it is in the non-stressed economies. Second, that many banks in the stressed economies do buy significant amount of their government debt. And the interest rates on the government debt are significantly higher than the interest rates on the government debt issued by the non-stressed countries. This, in a sense, offers tells what sort of way out will be out of this. Clearly, the establishment of the recovery, the continuation of fiscal consolidation, will both increase confidence, reduce the risk premium, reduce the interest rates on government bonds, and therefore improve the funding and the lending to the real economy.
So does that mean then that carry trades is what deprives SMEs and others of funding in the economy?
It's one of the alternative investments. If the interest rates were lower, the banks would lend more or would lend at lower costs. I'm not sure whether they would lend more because you have to look at what is the actual risk aversion by the banks in the economy. What are the actual risks? What is, more specifically, the rate of return adjusted for risks? But certainly, if the economy if the recovery were more established, you would see that these risk premia would go down. If the fiscal consolidation progress was more established, you would see that interest rates on government bonds would be lower.
And if the risk weight on the sovereign debt was higher, including if banks actually had it properly higher in their own internal models where they're supposed to, that would improve lending to the real economy?
That's a quite difficult question. On one hand, one would think that making lending to governments more expensive should make lending to firms relatively less expensive. On the other hand, if you increase the capital absorption for lending to governments, namely buying government bonds, you would have less capital available for lending to the real economy. So it's not an easy question to answer, what it would be the net effect of having risk weights. On top of this, if you were to have risk weights for lending to the governments, you should also think that these risk weights would be higher for the stressed countries than they would be for the non-stressed countries. And therefore, the absorption of capital would be higher for the stressed countries than it would be for the non-stressed countries. So you can see that the dimensions of this, of the answer to your question are complex.
It's a mess we've got ourselves into that we're not getting ourselves out of in that sense. Now for the S&D, Said El Khadraoui.
Dank u wel, mevrouw de voorzitter, en dank u, meneer de voorzitter, voor...
Thank you, Chair, and thank you, Mr. President, for your introduction. I would like to say something about shadow banking. And, you know that the Commission last week approved a gradual plan concerning money market funds. And you know that money market funds play an important role in the short term for financing of banking and governments, but they can also represent a systemic risk. The liquidity and stability of these funds must be guaranteed if the risk system is going to cover them. Then external ratings are also being addressed. Support from sponsors. There's often a reference to the greater risk of runs on funds. When it comes to CNFs, which have a more variable value, there will be specific requirements for CNFs of 3%. Do you think that this is a good approach by the Commission, or do you think that we need to go further? And as is indicated by the European Systemic Risk Board, perhaps CNAFs should be banned in favor of VNAFs? And are there other aspects of money market funds that should be looked at from the standpoint of systemic risk and addressed? Thank you.
Thank you. Thank you. Let me say, the ESRB issued a public recommendation on December 20th, 2012, to the European Commission on money market funds. We followed a line of thinking which is shared by the central banking community. See, for example, positions of the Federal Reserve in the US, where the role of money funds is, in terms of size and economic functioning, more important than in the US. According to this line of thinking, money market funds with a constant net asset value, the so-called CNAVs, represent an economically equivalent alternative to deposit services offered by credit institutions. For these reasons, CNAVs should either be submitted to the same regulatory provisions as banks, or legislation should provide for their compulsory conversion into variable net asset values, VNAVs. CNAVs represent a systemic risk because an investor run is possible, without, however, the possibility for regulators to intervene with the same instruments as with the banks. The European Commission has proposed on September 4th a proposal for a regulation of the European Parliament and of the Council of Money Market Funds. Proposal of the Commission proposes a different solution. CNAVs are not prohibited per se, but requested to set up a 3% cash buffer on the asset side. These funds, which are not able to respect this regulatory requirement, would be compulsorily converted into VNAVs. The ESRB will assess the recent proposal of the European Commission, also in view of its part recommendation. And I think we will do this in the course of 2014. So the answer to your specific question about whether 3% is enough or not will be given later on. At this point, I think I did say enough to let you know what is our thinking about this. Thank you.
All right, we might need it a bit quicker than that, but apart from that, because I think we'll be looking at it before next year. Now, for Aldi, Olle Schmidt.
Thank you, Madam Chair. Let me start, Mr. President, to salute you for your new gender policy within your bank. One could say that you listened to this House, the Council did not. Ja, Herr Langen, så var det. What are the consequences, Mr. President, of the creation of the fully fledged banking union, SSM, SIM, for the ESRB? Could this institutional model or framework risk to be complex and make rapid actions more difficult? And I would like to also ask you, because I'm coming from a country outside the Eurozone, and I regret it, but that's the case. What will be the case for banks outside the Eurozone with branches in the Eurozone? I've asked the question to someone else. I don't need to mention the name. And I really don't understand what will happen if they could be systemically risky. Lastly, you cannot leave this House, Mr. President, without saying anything about the election yesterday. This is a political body, and our mission is political. If I'm looking at the market right now, it's a bit jumpy. Will this election in Germany create more financial stability within Europe? Thank you.
Thank you. I will appeal to Madam Chair to be exempted from answering this question, and I hope that my appeal is accepted. On the first point is basically how will the ESRB and the SSM coexist? And our view is that they can operate in a contiguous but different institutional area. The ESRB is a network. The SSM will be a fully fledged institution. The ESRB has only soft powers. The SSM will take binding decisions. The ESRB collects all central banks and supervisory authorities, the SSM only the euro area. The SSM will exercise some of the powers which today are in the hands of the ESRB members, crucial powers in the area of banking supervision, and share competences with national macroprudential authorities in the area of banking. The tasks assigned to the SRB by the CRD4 and CRR will continue to be exercised by the SRB. An important overlap in terms of membership exists between the ECB Governing Council and the ESRB General Board, ensuring that the necessary flow of information on crucial macroprudential issues will actually flow across. And we've got to make sure that this works. The Advisory Scientific Committee has recently published a report on this issue, which I would invite you to look at as an interesting background documentation. Then you asked me about the banks that are not residing in the euro area but have branches in the euro area. In these cases, the supervision will be carried out according to the normal practices today, where you have councils of supervisors, domestic, and the home and the host country supervisors. Nothing is expected to change from that viewpoint with respect to what it is today. The difference being that before you had national supervisors on our side, and tomorrow you'll be having the central supervisor, the SSM. But other than that, nothing should actually change. Thank you.
May I repeat my question? Your answer is that you can see no problems with this new framework for acting very rapidly in problematic times.
No, I see no specific problem. If we are successful in establishing an effective SSM, I would see no problem. Parts of the success lies exactly in what you said. We should be able to act with speed, independence, and lack of conflict of interest. From this viewpoint, the present framework is certainly preferable from the previous one. As far as speed is concerned, however, we'll have to work on that to make sure that we are equally fast in implementing decisions that are taken by the center and implemented at national level.
But Ola, that is not to assume that the Commission proposal at the moment is perfect. We have yet to get our hands on it, and we will. Now, for the Greens, Philippe Lamberts.
Bonjour, Monsieur le Président. I'll speak English to make it easy for everyone. So you spoke about insurance and about banks, so I'll ask quick questions on each. On insurance, in Omnibus 2, in this sort of, so-called volatility balancer, it seems that the dampening of the volatility of the market is stronger, is actually only one way, that is when it's going downside, but not when it's going upside. In other terms, it can indeed do something to avoid the effect of fire sales, but it doesn't do anything to prevent bubbles. And seen from a systemic risk perspective, I would expect this to work both ways and not in a single direction. Second, on banks, your colleague and countrymate Andrea Enria mentioned to the ECOFIN in Vilnius that we had a big progress in Europe, that banks were now reaching a leverage ratio in Europe of 3.75%, which sounds quite weak, actually. What do you make out of some proposals that are being floated around saying, well, A, we've not been strict enough in CRD4 on leverage, and that we should basically target a 10% leverage ratio and impose it at least on systemic institutions? Wouldn't that go some way into really forcing more stability and more risk aversions from the banks? Because, well, I've got my doubts on risk-weighted assets, as you may know.
On the first question, we got to make sure that any measure that alleviates the impact of short-term volatility first doesn't create incentives for undercapitalization of insurance corporations or for concentration of risks. Second, and here comes more specifically to your points, measures should have to be symmetric in nature, not asymmetric. This means that buffers should be created when economic conditions are favorable. Third, measures should be transparent, and this means that investors should be regularly informed about the economic impact of those measures on the balance sheet of the companies. And fourth, vulnerabilities, and this goes without saying, but it's always worth repeating, vulnerabilities should not be hidden. On the second point, we had several numbers being floated on what is the right leverage ratio. We had the Basel Committee, which had said 3%, and then we had, I think, 5% also being mentioned as another leverage ratio. When we look at leverage ratios, we also look at international comparisons. And one point that's often made is that leverage ratios are lower for US banks than they are for European banks. Now, we've got to be cautious here because the accounting differences are relevant. And if one were to include the whole derivatives exposure without netting, which is prevailing in the US, the figures would look much less dissimilar than they look today. We've been reflecting on leverage ratios, and there is certainly something to say in favor of being on the strict side than on the sort of lax side. However, we should also be aware that too strict leverage ratios do have an impact on liquidity and especially on the so-called low yields, low return activities, which often are the ones that provide liquidity to a variety of markets. More specifically, what banks would do if with a leverage ratio that would be too binding, they would, for example, shed out the low yield activity, for example, the repo markets. So we have to, I'm saying this because we have to be careful in assessing the impact of different leverage ratios on markets that are essential for monetary policy, essential for a variety of reasons, but are markets that provide ample liquidity to all the important essential activities, but are also markets where the rate of risk of return are relatively low. And we've got to make sure the leverage ratios are not going to destroy these markets and therefore limiting the number of counterparties for a variety of transactions. We are seriously thinking about this issue, but it's not as simple as we thought until not long ago. So we don't have a view exactly on what is the 3% of the Basel Committee certainly allows for ample consideration of the present leverage ratios. Incidentally, there are banks in the euro area which also have a leverage ratio even lower than 3%.
Do you plan to issue a policy paper on that?
No, we don't have yet this on our agenda for next year, but we certainly take note of this, and we will reflect on this in the next board meeting. actually in the next steering committee meeting, which comes before.
If I may intervene here, I mean, the Parliament has some scepticism in some quarters on the risk weights, largely because politicians are very good at fiddling around with some of the largest asset classes of risk weights, in the sense of mortgages, sovereign bonds, SME lending, and we've gone and fiddled with it in CRD4, and that's not really then a proper risk weight in that sense. And surely netting is a little bit of arithmetic. But more seriously, when we were looking at this, when we were doing CRD4, we saw scope for there to be different leverage applicable to different business models, or indeed maybe even looking internally of a bank, the leverage within different sectors, which might help to overcome the problem of what do you do with those that are otherwise going to be chopped if you just have it as a blanket thing across especially a whole of a universal bank. You could say, right, different sectors of it have to stay within different... Anyway, I just say that that's some of where we got with our discussions.
You see, one of the beauties of the leverage ratio is that it's a simple concept that people understand. And it is a concept that doesn't need to play around with risk weights. So that's the good thing. It's quite clear, and it says something. If I understood, if we start having different leverage ratios across different activities, then we got to be careful about that, or aware that you could have arbitrage or placing different assets in order to minimize the effect, let's call it optimize the effect on the leverage ratio. So I think it's interesting, but we've got to be, we may risk losing the attractiveness of having a simple concept that disregards the choices of the bank's management.
Thank you. Now for the ECR, Ashley Fox.
Thank you. Mr. Draghi, you referred in your opening statement to Solvency II, and I'd like to ask you 3 questions on that. I've had the pleasure of following that dossier for more than 4 years now, so I share your desire that this be concluded as swiftly as possible. On the legislation itself, can I ask you to comment upon whether you think it is desirable for the European Parliament and the Council to be legislating in the detail that it is? Or would you, in fact, prefer the finer points of detail to be decided by the regulator? In particular, do you think it's appropriate for us to be saying what percentage of certain classes of assets should be held by insurers? Or, in fact, is that something that regulators should decide? And by writing it into legislation, are we creating risks for the future? Secondly, what risks do you believe there are that when we implement Solvency II, we will adversely affect the amount of investment in infrastructure projects? That's a concern of many members who are working on this legislation, and does that create a risk for the European economy? My third point relates to the use of credit ratings. In CRA 3, we said, the Parliament said that all references in EU law to credit ratings for regulatory purposes should be phased out by the beginning of 2020. And yet in Solvency II, we're busy writing into law more references to credit ratings. So I'd like your view on this. Do you think that's a sensible thing for the Parliament to be doing? And do you think that, in fact, these specific references to credit ratings within Solvency II could, in fact, increase risk? By which I'm referring to the cliff edge effect. If we say insurers can't invest in anything that's below BBB, are we, in fact, storing up problems in the future? Thank you.
What is the optimal mix between a detailed legislation and regulators' discretion? It's pretty clear now from another variety of other issues that if we let the regulator to be completely free, we end up having regulatory arbitrage. If we have a completely rigid legislation, we may risk in a manner in an area like this one, which is subject to continuous change, we may risk obsolescence of the legislation. So where the wisdom will place the right line is a difficult issue. The ideal thing would be to limit the regulator's discretion and at the same time have legislation that can be easily adapted to the various varying circumstances. We are moving towards, in all other areas, we are moving towards, however, we should keep in mind, in all other areas, we are moving towards a more uniform, harmonized system. So to behave differently in the Solvency II would, in a sense, run against what is the general tendency of financial regulation in recent times. On your second point is if Solvency II reduces insurers' ability to provide long-term financing to the economy, well, we don't have evidence to this extent for the time being. Insurers continue to invest medium-long term, and their investment policy is driven by the need to match liabilities and assets duration. The signs that insurers move to long-term and illiquid investment to take advantage of higher rates of return in the current environment of low interest rates are there. So we believe that none of these arguments is used in the short-term discussions on the long-term guarantee package to obtain capital relief concessions. I think that's another dimension that we should keep in mind. You also asked whether we have a view on whether should have a risk weights set by the legislator on EIOPA. I think I've answered this question. What else? I'm sorry, what else?
Credit ratings, and whether it's appropriate for us to be putting specific references to credit ratings in Solvency II, Omnibus 2, when we've only just passed CRA 3 saying that such references should be phased out. I mean, do you think this is useful and appropriate to include those references in this legislation?
We haven't thought to this yet. So we will certainly report to you as soon as we've gone through this. Thank you.
Meanwhile, we're building in a BBB threshold, which many sovereigns can't even reach at the moment. So that's going to be interesting in a little while. Right, for the GUI now, Nikos Chountis.
Ευχαριστώ, κυρία Πρόεδρε. Κύριε Πρόεδρε.
Thank you, Madam Chair. President, roughly 2 months ago, I asked you what your assessment was of what are called red credit, red loans in Greece. And I asked you whether the 50 billion for recapitalization of banks, if that was not sufficient, what were you going to do? 2 months have gone by, and I won't ask any new questions. I'll simply repeat that question I asked you 2 months ago. You said at the time that you were just as concerned about these loans, these red loans, and that you weren't very concerned, however, about the health of the Greek system. And I'd like to know whether you have any more information for us today. Secondly, a question related to your office. The importance of these red loans in the balance sheets of Greek banks. Do they represent a systemic risk for Greece or for other euro area countries? And finally, I would like to know whether the supervision carried out today by the Bank of Greece of banks' balance sheets shows, if it shows that the amount that you have set aside for this is not going to be sufficient, how do you plan to save the banks? How do you intend to do this?
Well, we never discussed the specific point of these type of loans at the ESRB. And but let me say that if we are not at the point in time when we want to discuss further financing needs for Greece. We had the program that runs at the end of 2014. We had the IMF program which runs until 2016. So I don't think it's yet the time to say what if the money is not enough. On the specific loans, as I said, we haven't discussed it in the SRB. And on this, you asked me also a question about the supervision of Bank of Greece. Could I ask you to repeat the question?
Πολύ ευχαρίστως. Καταλαβαίνω και η κούραση και η διάρκεια της συνεδρίας.
Yes, I'm quite happy to do that. I understand that this meeting has been going on for quite a long time. My point was, in the case that the supervision exercised by the Bank of Greece and by the ECB shows that these red loans are a problem for the bank's balance sheets, and BlackRock is doing the same investigation, and if it emerges that the 50 billion is not sufficient, I'd like to know, what do you plan to do? Are you going to discuss this with the Bank of Greece, or are you doing that?
No, at the present time, we haven't really faced this problem. And as I said, what to do, we'll have to see. At the present time, resources are enough as the program foresees. Yes.
Okay. Right, thank you. And now for the EPP, Werner Langen.
Ja, Herr Präsident, ich war...
Yes, Mr. President, I wasn't really sure if I understood you correctly concerning the money market funds and the Commission's proposed regulation on shadow banking. Would you agree with the Council's proposal that funds with flexible payouts should be banned in favor of those with 3% cash buffered? Now, you mentioned risks about clearinghouses, CCBs. I think when you look at the extent of derivatives worldwide, the netting in the United States is much more risky than the possible problems caused by a CCP. If I remember correctly, it was on the 15th of September 2008, 1.27% of risks were covered by derivatives on the balance sheets of American banks because of this netting, and nothing had to be proved. You said that the responsible body is making proposals. Now, what do you think about companies that are used by companies, derivatives are used by companies? And my third question, it's already been raised. Cooperation with the Basel Committee, the zero assessment in assessment of state bonds. This has already been addressed by the Basel Committee. Is it possible over the long term that this risk assessment of zero for sovereign bonds would gradually move towards a more realistic assessment, and that this would resolve some problems in the long term?
Thank you. On the money market funds, I did say before what we think about this, and so I said that the CNAVs should be subject to the same regulatory provision as banks, or legislation should provide for their compulsory conversion into variable net assets, VNAVs. So I think I did say enough. And I think there is some room for improvement, as Madam Chair has said, with respect to the proposal. On the derivatives, one of the, in a sense, best developments of the work that has taken place after the financial crisis was the fact that all the standard derivatives contracts would be cleared through CCPs. And the data would be stored with trade repositories. For the non-standard derivatives, there would be separate clearing, but with more punitive capital requirements. Now, it's turning out that even though the process is continuing, it's turning out that it's actually at worldwide level to be more difficult than all of us had expected, and especially you, since you are the EMIR rapporteur. So I think we've got to continue working on this with these two sides, two angles. Maximum transparency on one hand, and on the other, we should address the fact that the CCPs could become source of systemic risk. Thanks to EMIR, a new set of granular data will be available in Europe. It will be collected by trade repositories, made available by them to ESMA, the national authorities, and also the ESRB. So thanks to EMIR, this will permit to study what type of exposures, concentrations, and possible contagion effects are developing. I think the ESRB has a task to warn and recommend to all authorities at European and national level. It also creates, through its normal operations, a dialogue forum involving all of them on a permanent basis. And the ESRB, as you know very well, will be asked under EMIR to give macroprudential views on procyclicality and interoperability, as I've said in my introductory speech. On the, indeed, very difficult question on risk weights, during the last General Board meeting on September 19th, a group of experts, including from academia, presented a technical report on this topic to the ESRB's General Board. We had what I would still define a very rich, fruitful discussion. The discussion concluded that this report is a good starting point to better understand the risks arising from sovereign exposures and how these risks could be mitigated. But there is no ESRB policy action foreseen in response to this work. There is neither an ESRB warning or recommendation envisaged, nor are there any formal step being considered. We will continue working on this topic, however, with a view to publishing a report of scientific nature. And I will certainly inform this committee about any progress in this area in due time. However, I expect that this will not happen before the SSM, ECB balance sheet assessment and stress tests have been completed. So, thank you.
Okay.
Thank you.
Okay, thank you very much, and thank you very much. It's a long time to answer questions for 3 hours, so thank you very much, and thank you for the information that you've given us.
Thank you.
Okay, thank you.
Thank you.
And we'll see you again before too long.
Yes, absolutely. Thank you.
So that's it until tomorrow at 9.